Hi, everybody. Bear with me a little bit because this is my first time speaking at this conference, and I've done it virtually, but never in front of this big of a room with all you guys. So it's been quite an eye-opener to join everybody here, and it's been a real honor. So the talk today is what the fear gauge is telling us about the stock market, and we're just, the fear gauge, what we all know. Am I going the wrong way? No. Sorry. So my key themes today are: what does the CBOE Volatility Index, VIX, measure? What does VIX not measure? And the importance of correlation and dispersion in how the index is managed and how the index reads. So it's very important. It's very important to understand that. And then, of course, sort of the current trends in volatility. So this is a little bit of a word salad here. I'll skip it. Just take a quick glance at this is the definition from the CBOE of what the CBOE Volatility Index is. Financial benchmark, up to the minute market estimate. Basically, it's telling you that it takes the average of volatility, implied volatilities on the S&P 500 index options with roughly 30 days to expiration. And it's basically just a strict mathematical calculation. And we go on here, this is more boilerplate, but just take a quick glance at it, because there's one thing that people expect to see in there, and that's not. And that is, what word is noticeably absent from these explanations? It's a bit of a loaded question. Anybody pick up what word was missing? Fear. So you typically hear VIX referred to as the market's fear gauge. It's not calculated that way. Yes, it's calculated off of implied volatilities. Implied volatilities usually represent uncertainty, but it is not. Hello? But it is. Hi, sorry about that. But it. Oh. Anyway, I'll shout. But it is. Oh, there we're back. But it is not. It is not specifically meant to measure sentiment. This is the thing I'd like you to take away. One of these two statements. Either VIX is not now, nor has it ever been a fear gauge, fear index, or, my favorite, VIX is not a fear gauge, it just plays one on TV. And so this is basically going to be the theme, and this is one of the themes of my work all the time. And just for a little bit of background, so I was a market maker, I was a stock market maker, proprietary stock trader for the first 7 to 10 years of my career, then joined what was then this little options market making firm that was getting into equity options. It was mostly an index options trader as the guy to manage the equity risk and look at, basically the monsters under the bed that could go wrong when you have this big portfolio of options. And so I'm very attuned to, the underlying risks in the market. And when VIX came along, it was great because you could measure it was really a good measure of volatility. We had to do it ourselves, and the CBOE is now doing it for us. But it's not about fear. But yes, it does. It's understandably. My definition is this: VIX is the price of parachutes when a plane hits turbulence. This comes from my experience as a market maker. Nobody really wants umbrellas when there's a drought. Nobody really thinks about a parachute if the plane is moving along smoothly at 30,000 feet. But as soon as you hit some turbulence, or as soon as the rain clouds develop, people want them, and they want them in a hurry. And so to me, I view VIX as the most efficient way for an institutional manager to hedge his or her risks in the short term. So yes, there is a fear element to it because you see people running in and saying, I need that umbrella because it's going to start to rain, or uh-oh, the plane's hitting some turbulence, I better reach for the parachutes. But it's really not on a day-to-day basis measuring fear. So yes, sentiment certainly plays a role in VIX, but it is by no means the only factor in the pricing. Things that influence it are expectations for future volatility. Again, this is a market look ahead. And so markets are discounting mechanisms like basically everything else. And so again, because we're using the implied volatilities of options that trade with an average days to expiration of about 30, this is the market looking ahead. And in an environment now where the volume is increasingly moving towards shorter dated options, people like to say, is VIX not measuring things properly? It is. A lot of the trading activity has migrated toward ever shortening option dates, and I'll talk about that at my next topic later on today for those of you who are interested in it. But there are still those who trade the 30-day area of the curve. And that's what VIX is measuring, and it's very much institutionally driven rather than retail driven. So it's a bit of a different read than you get. Historical volatility among options market makers, quite frankly, it's just the starting point. Well, the 20-day implied volatility was 14, so I'll start my pricing at 14. And that's really it's sort of backwards looking. For a forward-looking thing, it's sort of backwards looking, but that is honestly how market makers do operate. The wings. And what I mean by that are extremely in the money or out of the money options. The real extreme downside, the real extreme upside. VIX uses, in its calculation, I won't get into too much of the weeds, but it uses, included in the pricing are every option that has a bid of a penny or more. So those can be things that are 15, 20% out of the money getting you introduced into the calculations. So a lot of times the calculation gets noisy based on where people's desire for protection or speculation is. For example, in a lot of 2021, VIX was giving very high readings largely because the upside volatility in SPX was so high because the market was so rapidly speculative. Worked out for a lot of people, but it was influencing VIX higher. So a lot of questions I got was, wait a minute, it's reading fear, but it's not fear, but nobody's fearful. That's one of the things that comes into it. Correlation and dispersion, which I'll get to more, and of course, yes, sentiment, because people's perceptions of volatility looking forward are, because I said it's backward looking, so if it's volatile now, people project that it will be volatile in the future. If it's not volatile now, people project that it won't be. And so that does play into it. Just a quick rundown on historical versus implied volatilities. Implied volatilities usually follow historical volatilities, but you do get spiky stuff here and there. In this case, you have SPX implied volatilities generally moving, which is, I believe, the white line. I can't see my own writing here. Moving with the 10-day historicals. But the problem with graphs like this is you don't really know what expiration a lot of times that they're using for your implied volatilities. I happen to know because I helped write this formula for the Interactive Brokers website, but it's 1 month, but it can get a little misleading when you start to look at implied versus historical versus forward. Then I mentioned the wings, the importance of skew. So this is a fairly typical skew graph, and we like to call it the Elvis smile, especially very appropriate here in Vegas, right? So Elvis had that sort of crooked smile, I can't really do it, and usually this is because there's an insurance premium baked into options markets. It didn't exist until 1987. The skew curve was flat as a pancake. And then the crash happened and people said, oh, wait a minute, we need insurance. The price of insurance went up, that's the downside. And so you have this skew. And as those skew changes, those really out of the money options get priced into VIX as well. So that's important. So as skew flattens or steepens, depending on and in which direction it's flattening and steepening, it has an impact on the calculation of VIX. But this to me is an interesting one, correlation and index volatility. And people lose sight of this a little bit, but think of it very broadly. Let's say you have an index of 10 stocks, okay? Half go up, half go down. Let's say it's all equal weighted. What'd the index do? Nothing, right? And those stocks could have moved dramatically. You could have had half those stocks move up 10%, half those stocks move down 10%, but they all balance each other out, and the index does nothing. On the flip side, if you have very high correlation, let's say you have all of those 10 stocks, but they all move up or down 1% at the same time, well, then the index moves 1%. So correlation is sort of like, correlation and dispersion is sort of the sand in the gears of an index. And typically we see correlation really spike when it hits the fan. I mean, and that's sort of a human nature thing because you have the get me out trade, you have margin calls, et cetera, et cetera. And just, sentiment changes dramatically. So correlation does get impacted by sentiment. But in a normal trading environment, in some ways it measures rotation. And in some ways dispersion can be very good because when you have a period of high dispersion, meaning stock prices are all over the place, it benefits stock pickers. It's a stock picker environment. When correlation is very high, it's more of a macro-driven environment. But because these factors of the 500 stocks in the S&P 500, and increasingly really 8 stocks, which make up a third of the S&P 500, depending on how they're moving, that has a huge impact on how VIX gets priced and how volatility works in the marketplace. So what I drew up here on this graph is there's an index that nobody really watches. It's called COR1M. It's also a CBOE index. It didn't really mean this as a plug for the CBOE, but they have really good data people. And this is basically a measure of the volatility correlation of the top 50 components of the S&P 500. And what we see here is, as you would expect, VIX moves pretty consistently with COR1M, all things being equal. There's usually a little bit of a pattern. But I have noticed something here. It's tough to see, but there's some little arrows I drew on the graph. And basically, what I've noticed a few times, particularly recently, is when the correlations drop and VIX hit like a local short-term low, and VIX doesn't, that's often a tell for a bit of a higher VIX to come, because it's telling me that people are saying, okay, we know the correlation of the index is moving, but we're still keeping our volatility hedges in place. And so that to me is a little bit of a tell. And so I drew, you can draw them out with the little arrows. You can see them there. As we say, nothing is foolproof, but this is a little tell that I use to see where VIX might be going. And so correlation, dispersion, they're poorly, they're difficult to explain. I'm certainly not going to bore you guys with it all here, but it does make a difference. And that's why it's helpful that there's an index out there that you could point to. The CBOE has different ones, COR1M, COR3M, 3-month. I use 1M because VIX is a 1-month measure. Remember, VIX is the market's best estimate of volatility over the coming 30 days. So why not match the two volatilities as best as I can, the two measures, the correlation and the VIX. And here's the long-term view. It's important to understand where VIX goes and what it does. And you notice it has a little bit of a tendency there. It's sort of like a scary movie EKG kind of thing. And for the most part, you have these long, steady states. And VIX tends to, in the long term, depending on the market environment, it can sort of hang out in the low teen, the tweens or the low teens, which is what we saw, basically during most of the more recent bull market phases, of which we've lived in several of them. You get the crazy spikes. The last crazy spike you see there was the Japanese yen carry trade imploding at the beginning of August. And this is sort of the problem with VIX. And I know people sort of like to think the idea, I'll short volatility, I'll short volatility, I'll short volatility. And it's one of those things that works until it doesn't, and it doesn't work. When it doesn't work spectacularly. And right now we are seeing VIX, as we look in the current environment, sort of mired more in the mid to high teens. In the mid to high teens. And I do think this reflects, and Christina said it much better than I could have. There's policy uncertainty out there. There's a lot of moving parts in the market. We don't, with all the tariff talk, with all the moving parts in the market right now, I think what you're seeing is a little less willingness of people to just throw caution to the wind and say, I don't want these hedges. I don't need these hedges. So there's a little more underlying demand for hedges because the environment is uncertain. There's also the spike, Christina mentioned the spike in inflation expectations, which has really been kind of wild because usually 1 year, and you can find that I put this up on Twitter pretty much regularly. Basically, that 1 year inflationary expectations tend to follow the price of gasoline at the pump with a little bit of a lag. But lately, those expectations have been spiking hard. At the same time, consumer sentiment has been coming down hard. And so, soft data. I'm being followed by one of the street's top economists. I'll let him go through it much better time than I will. But this is sort of the underlying grinding uncertainty that you see. So I think what we can expect going forward, at least until this is either resolved or not, that you're going to get, you're going to get more of a little bit of a steady state in VIX at higher levels than we've been used to maybe. And sometimes I think the market's kind of not reacting too heavily to each of the various tariff potential pronouncements, Again, there have been roughly 6 of them, and only 1 of them have been implemented. So the market's market's reacting in a small way, but not in a big way anymore. But I think as this plays out, my one constant is it's a little tough right now with the new administration. This is not a political statement. This is an administration that is doing a lot. It's been in office a month, and many of the changes have been profound. And so I think what you see here is because VIX has the tendency to sort of just shoot higher, because that is, again, everybody rushing to the umbrella stand or everybody looking under the seat for their flotation device. You do tend to get these spikes. So I think, you hear the phrase buy the dips, and it's been a phrase that's working for a lot of people for a long time. VIX is another one of those things. Volatility overall is one of those things that I think it behooves you from time to time to consider buying on the dip. It's like nothing else, although it does, of course, have the tendency to move lower when markets are higher. But one of the calls I hate getting is when people will call me up, market was up today. Why was VIX up today too? And it's not about that. It's not just, it does over time. Yeah, there's a inverse correlation between the S&P and VIX, but it's not perfect. And I wanted to, I hope what I gave in this talk was the explanation for why that's not perfect, why there's a lot of factors underlying the calculation of VIX and the index that we should all be reckoning with. And I think that's all my prepared stuff. Please, I gave you where you can find us, Interactive Brokers. IBKR Campus is our learning platform. Please use it. That last little URL is where I publish. Basically, I try to do it every day. I'm not doing it today because obviously I'm here. But it's all free, and so we'd like you to use it. Do I have time for a question? Okay. Sure. Yep. That is a great question. You're right, because when you're buying what is very important if you're trading options on VIX, you're not trading options on spot VIX. Actually, when you're trading any options, you're trading options on the forward value, right? So you really options are priced off of whatever date it is. Now, if you're trading short-term options, it doesn't matter. In the case of VIX, there's the VIX futures curve, and so if you're trading VIX options, those are priced off the futures curve, and so a lot of times what you'll get is. This is a very key, and I love that you brought this up. I didn't know if I was going to have time to address it, so this is perfect. VIX, what you should also be watching from time to time is the VIX futures curve. And like any other futures curve, it tends to be in contango, meaning it sort of slopes up to the right. VIX has an interesting tendency to get inverted from time to time. Again, that's that rush in. Inverted yield curve, inverted curves, or backwardation in futures terms, tends to mean that the commodity in question is in very short supply in the near term. And in this case, volatility protection is the commodity in question. So a lot of times what will happen is you'll see spot VIX zoom, but you won't see the outer months necessarily rise as quickly, or in some cases you'll get like a little hump in the curve. And so that's unfortunately what you're seeing. I've gotten this question before. I love that question because it takes me into a place that I don't know if I should always get into the weeds, but it's very important. And that's something you have to keep an eye on. So if you buy a 1-month VIX contract, you're looking not at VIX now, you're looking at what the market thinks volatility will be in the 30 to 60-day period, because it's a 1-month look ahead. So you can get these dislocations, and that's where a lot of times you get to, it can be very confusing because it's not necessarily explicit that that's what you're trading. So please keep an eye on the VIX futures curve if you're going to be trading VIX options. Well, I mean, That's a great question, because I tend to either use Bloomberg or the Interactive Brokers Trader Workstation. I know where to find it on both. Bloomberg is obviously, more beyond the reach. I believe the CBOE has that information somewhere. If anybody knows, and then if you trade with Interactive Brokers, it's under the term structure of volatility. It's under the term structure of the VIX. It's a futures term, is what it's called. Welcome. Sure.
You mentioned that the VIX is currently hanging out in the high teens at the moment, and I think the historical average is around about 13, 14, something like that. A few years ago, we were experiencing VIXs quite commonly over 20. What do you think would have to happen for it to get back into that regime and even further? Obviously, we had brief periods, albeit thankfully, where the VIX was over 30.
It comes to the underlying volatility in the marketplace. Volatility has been very suppressed. I think the actual activity right now that you see it's almost every dip has been bought. This has been ingrained in traders' minds, institutional and individual, that every dip is a buying opportunity. And far be it from me to say it's not, because quite frankly, it's been something that's worked really well for a long period of time. So the market has been getting, the moves have been getting dampened. There's pretty much, on that Japanese yield, the Japanese yield implosion day, I had two calls from friends. One of them was a CFO at a company saying, should I be worried? The other one was a friend of mine who's an individual trader in Denver going, 65 VIX, and so there's different mentalities. So, the one guy whose job it is to make sure his company doesn't go bankrupt was generally concerned that this could spill over. The guy who basically makes a living trading aggressively saw this as like the opportunity, one of the opportunities of the year. So I think I do think you need to sort of break the mentality that every dip, no matter how large or how small, needs to be bought and needs to be bought immediately. And again, buy the dips is a strategy that's worked for traders for as long as they've been traders. They're probably somebody buying the dips in Sumeria, or Mesopotamia, that kind of thing. But I think you need a little bit of a more little less willingness for that to happen, a little more propensity to get a couple of shocks to the downside. I don't even mean like big shocks, just sort of a few more 1% days, that kind of thing, 2% days, and I think you do start to see it higher, because it will reflect what the market's doing. So, has anyone heard the term rule of 16? Raise show of hands. Quick, okay. The rule of 16 is, if you're an options trader, memorize this. Basically, when you look at implied volatilities, they're in annualized terms. So VIX is in annualized terms like everything else. It's a little bit of a rough calculation. But broadly speaking, a 16 VIX is 1% daily moves being priced in. The rule of 16 says when you annualize by a factor of the number of business days. That happens to be conveniently around 256, which is conveniently 16 squared. Options traders are really good at dividing by 16 and multiplying by 16. So what you're saying here is the market, when you see like a 16 VIX, that's the market pricing in roughly 1% moves plus the wing, less than 1% moves plus the wings. So if you get a little more sustained movement, that keeps VIX sustained in the 20s. Art? I do, and that's why I think it can actually lead to the explosions. The question was with the risks, with the propensity of just covered call writing, either ETFs or just strategies for money managers. It does suppress the volatility. It has sort of suppressed the upside in index, whereas a lot of times you'll see the stocks have skews that are flat as a pancake, even going into earnings, because nobody wants to miss the upside. You do have this, and these covered call strategies do sort of suppress upside volatility to some extent. And because, again, VIX is measuring S&P, and that's one of the things they're using, it does actually have a little bit of a depressing effect on VIX because it is at the wings. Great question. Got it? Clear as mud? Well, thank you, everybody. Thank you so much. Thanks.